Welcome back. You're watching Midcap Radar on CNBC-TV18. Let's put the spotlight on Quality Power electrical equipments. The company reported a mixed set of Q4 numbers. Profit and revenue growth came in very strong, while the margins contracted sharply due to higher cost of materials. We are now being joined by Bharanidharan Pandyan, who is the joint MD and whole-time director at Quality Power Electrical Equipments. Well, good afternoon to you, sir. At first, I'd like to start off by asking you about the kind of growth you're penciling in for FY26. The growth in FY25 stood at 12%. You have an order book of around 750 odd crores. How much of this gets executed in FY26?
Very good afternoon, ma'am. Thank you. Thank you for having me on the show. Our revenue guidance for the year is between 700 and 800 crores that we have already committed on the earnings call. The margin shrinking is not so much as what is shown. We have always had the issue of IFRS and IAS 29. Some of our earnings from our Turkish subsidiary are classified under other income due to the hyperinflation formula, where the price variation clauses are treated as other income rather than the operational income. Otherwise, the margins are more or less stable. We have made an excess of about 101 crores in profit after tax this year. We believe the growth is going to be solid this financial year, considering the headwinds, the tailwinds in the sector. The 750 crores order book is the unexecuted order book as on date, is just 2 months into the year, and we believe the year we have a lot of more positive surprises coming up.
Okay, Mr. Pandyan, we get that point. When we're looking at the export order book, especially in the first half of the last year, it was at over 70%. Where does it stand at currently as a part of your total order book? Also, are you seeing any further uncertainty, especially given worries around tariffs? Also, you have a significant presence as far as Turkey is concerned. Are you relooking at that particular partnership as well?
The subsidiary what we have in Turkey is over 15 years now. We have business there, but it doesn't serve Turkey alone. They serve across the world. We serve in Australia, in Africa, in Middle East. Amount of direct exposure we have to the government, Turkey and India, is close to negligible. I believe it will be even smaller because of the kind of growth we are seeing in the renewable energy sector across the world. With regards to exports, I believe the blended numbers, because Mehru acquisition was done in March of last year, so which means we couldn't take the consolidated numbers. Going forward in the Q1, Mehru will be consolidated with us. We believe they did about 250 crore plus of revenue last year. So they are primarily a domestic vendor. As we are increasing their export share, we believe we should be about 50-50 in domestic and exports. But our export books are quite well. We are one of the very few players across the world who make this equipment. So we are seeing a lot of traction, including we just got a contract out of Hong Kong, a 1-year contract with the local utility, the CLP.
Sure. And, if just talking about your order inflow, right? You mentioned earlier that you were expecting some surprises this year. So could you quantify that for us? What is the kind of order inflow you had in FY25 and what would it be in FY26? And what is the demand situation looking like on ground? Are there any sort of delays, concerns, as Vivek was just asking you?
The pressure right now for most of the high voltage equipment manufacturers across the globe has been on the capacity. The demand is ready to pay a premium for capacity and delivery. Most of the HVDC projects in the world are coming up very fast. National Grid in Britain, which is the British power grid, equivalent to power grid of India, released an order for 59 billion pounds a couple of months back. And that is the kind of numbers we are seeing in most of the utilities coming up in the next 2-3 years. So it will be an execution challenge for smaller vendors like us to be able to ramp up our show. So I believe it's more of an execution side worry rather than an order side worry. We could ramp up our order book how much ever we want if we have a capacity at this moment.
Okay, Mr. Pandyan, would you be able to quantify two numbers for us? Number one, the order prospect pipeline. You gave us an example of British equivalent of India's power grid. You've also given us examples of various Capex that's been done across the world. So what is the order prospect pipeline, typical win ratio for you, and what are you penciling in terms of order inflow for FY26?
We believe we should be able to tag along another 500-600 crores of order again over the 750. I think that would be a conservative estimate if we win some of the HVDC jobs that are on the pipeline. Plus, again, the high voltage transmission sector, where we have a significant exposure with Meru, that is also increasing. And the STATCOMs and the SVCs we are delivering, we see an upside coming up with the metal prices soaring again.
Sure, and you just mentioned that capacity is a constraint, but you have two coming up, one in Cochin, which will be operational by November 2025, and one in Sangli, which will be operational in Q2 of FY27. So what is the kind of revenue potential that you see from these new capacity additions? And this is what I'm asking you about is at the full utilization of the capacity, and what will be the margin kind of contribution that would come through in FY26 and FY27?
The peak capacity output of these two plants would be about INR 2,000 crores, give and take, which we believe would be suffice for the next 2-3 years till we are able to execute the orders that may come in. With regards to margins, because we have some blended margins coming up, that means we are consolidating Meru and some of the M&A opportunities that we're looking at. So the blended margins we are giving in around 15%, but on the existing product side, I think it should be higher than 20%.
And when will you be reaching the peak utilization for both of these facilities? How will they ramp up?
We have a 9x capacity addition that is coming up in the next 1 year's time. I believe it will take about 2,000 odd people that we need to take in to ramp up the numbers. If we are able to ramp up on time in process, I believe in 3 to 4 years' time, we should be able to get the peak capacity.
Mr. Pandyan, you spoke about a 2,000 crore capex. Number one, how are you?
The peak numbers that can
Understood.
The revenue.
Okay, got that. So what is the capex that you have penciled in? How are you funding the capex? Internal accruals, or are you raising debt? And typical asset turns for you?
We are not raising debt. The promoters are infusing the money through the OFS, whatever we raised. We have done a repo plus 0.5, what we say over a period of 15 to 20 years to ensure that our current cash in the hand, we are sitting in over 150 crores of cash. We do not want to put it in Capex cycle at this moment where we see some interesting M&A opportunities. So we are using the company accruals and the profits for growth cycle at this moment. The asset we are putting in as a soft loan. So we are not raising any external debt at this moment.
Sure, and with the kind of capacity addition that you will do, there will be some expenses that will be involved in setting up the facilities, bringing on the manforce, and then sort of scaling it up. So, do you think that there could be some pressure on the margins in FY26 and 27? The period within which these facilities will ramp up, because historically, when I look at your numbers, your margin, your EBITDA margin has ranged between 12 to 13% typically, and this time around it's spiked up to 19%. So, will you be able to sustain this, or can we expect some pressure?
The margins are more or less constant, ma'am, for the past 5-6 years. But when we shifted from a in-GAAP to Ind-AS during the IPO, we had to, classify a lot of our operational income under other income, especially of the subsidiary. As we try scaling up, either through organic or inorganic, the margins may be what we say slightly varying, maybe a couple of percent here and there. But I think on the sum total of what is a magnitude, I think that will be a addition. So what the PAT would continue to increase.
Right. Mr. Pandyan, one question. You've gone ahead and constituted a task force to explore acquisitions. Could you give us a sense of the size of the acquisition? What will be the targeted entity? What will be the business that they are in? And how will you fund these acquisitions if you manage to go ahead and come to a fruition?
So at what we say at cash and bank, we have at this moment about 210 crores, give and take. What we say with more being generated every day. So I believe with the promoter OFS, we would be able to fund something in the range between 300 and 400 crores. That is a kind of war chest we are sitting at this moment. With regards to what we are seeing synergies, we look at high voltage electrical equipments. We are looking at, again, stuff in the power sector where we feel that we can have the same customer. The CAC is almost zero, where we can sell it push through. We are quite excited on the power electronic space, especially on energy storage. We are looking at a couple of companies, again, in the Western markets, primarily because those technologies are not available in India. We are also trying to partner with other similar like-minded companies where we can look at co-acquisitions wherever it may be.
Right. Thank you so much for joining us, giving us a sense of how FY25 panned out and what we can look forward to as far as FY26 is concerned. Thank you once again. Well, as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.